Everyone say hi.
Hi.
My name is Tyler Nance, and I'm going to be talking about investing to all y'all. Okay, good start. There we go. So what we're going to talk about what investing is. We're going to talk about the different types of investments, whether you're going into the stock market or whether you're going through bonds or other various sources of cash investments. We're going to break down the different types of what they are individually. And then we're also going to do the 5 steps for successful investing. So understanding investing. So the first step is understanding what the definition is. So to invest is to allocate money and the expectation of some benefit in the future. In finance, the benefit from investments is going to be your return, the reward that you get for the risk that you put in. So some examples of investments can go from real estate to cash investments, then go to stocks. There's a lot of different ways that you can invest. And then so the biggest thing is also going to be the risk versus the return. That's one thing that you also have to pay attention to. The more risk you put in, usually the higher return you put out or that you receive. So then the 5 different types of investments, you have growth investments, you have shares, property, defensive investments, cash, and then a fixed interest investment. And we'll break those down individually. So the first one is a growth investment, but this one is in shares. There's 2 kinds of growth investments, and we'll get one in going into the next slide. So a growth investment is dedicated to long-term growth. It's a very safe option. What it will do is that it's based off of just growing whether your portfolio and then also moving forward and growing the amount of return that you're going to get rather than keep it being a steady, regular amount. So like a cash investment, which we'll go through later, will give you a steady amount every month, while this can grow into being a lot more each month. So it's dedicated to the long-term growth where the consumer's understanding of market ups and downs. So basically as the stock market goes up, you'll benefit, but if it goes down, obviously you're not going to benefit, but you're accepting of that it's going to happen. And you're looking at more of 20 to 30 years rather than you're looking for a big return as of tomorrow. So normally referred to investing in companies that have attractive features. So people sometimes invest in like Apple, and they've been looking at how it's been going over for 20 years, and that would be a growth investment. It's over a long period of time that they're looking. And then they tend to have long-term gain and also tend to not be as risky. So it's going to be a really defensive kind of way. So another growth investment is property. So an example would be like Airbnbs or even like strip malls. If like you drive down the street, you see like a mattress firm on the side, you can actually buy those and you can have the companies pay you more than what it would be for the rent, and then you can then charge them a little bit more, and then you can make a profit off of having those strip malls. So the different types of properties can be a short-term but a large down payment. So you have to pay a lot in the beginning, but if you look at the full time, you can actually make a lot of money back on it. So different examples could be as simple as owning land or as complete business as rental properties like bed and breakfast or strip malls. And then this poses the risk of the housing market. Obviously in Illinois, the housing market where I'm from is a lot worse than it is here. So here you can buy, 3,000 square foot house and it can be $150,000, but in Illinois, a 3,000 square foot house would be probably about $400,000, $500,000. So going into a defensive strategy. So a defensive strategy is usually done. Usually you hire somebody to have to work through a defensive strategy. What it is diversifying your portfolio. So this would be an example of one. You have like your equities, you have your bonds, and then you have like your stable values, and you diversify your portfolio so you're don't have all your eggs in one basket. People often, again, hire individuals to do this. It's a more complex and time-consuming. Obviously, you have to pay attention to what you're investing in to make sure that you're going in the correct direction. And then it entails diversifying your portfolio with high-quality short maturity stocks and blue chip stocks. So the short maturity stocks and blue chip stocks would be examples of Apple or Tesla, the S&P 500 stocks, the bigger ones, not penny stocks or microchip stocks. Those would be companies that you honestly have probably never even heard of. For example, one that I invested in was called Novavax, and then all of a sudden now it's turned into a blue chip stock because it's a major vaccine company working with COVID-19. Yes. So cash investments. So cash investments are going to be what I was talking about earlier. It's a regular growth. So what you do is they're made daily in bank accounts, and what you do is you place cash in high interest bank accounts, and then the interest that comes in, you take that profit, and then that's what you take that money, and then that's what you can use as your profit. So if you get a percentage interest and you get $300, Well, if you leave that money in there, you can get that $300 again and again and again and again over a period of time. They offer no chance of capital growth. So basically, it's a regular fixed income. It's never going to grow like the previous ones, like properties or like stocks that can go up and down as the market goes up. A cash investment will always stay at the same price, and you'll always get the same amount back, which can be a good thing. It can also be a bad thing. What they're good about is that they have a very low risk because they're always going to be the same. So they use high interest savings accounts, or saving accounts that pay better than average interest rates. These higher rates may come with conditions like minimum balance requirements or maintenance fees. And then another example would be a term deposit. A term deposit is a fixed term investment that includes a deposit of money into an account for a financial institution, so like a bank. So one of the last ones is going to be the fixed interest. It's the most well-known example is bonds. Bonds are very similar to stocks. They're just a lot safer. So they're usually government issued, and you invest them into companies, and then the companies have to pay that back, and then you profit off of that, the interest that you get back from that. So other examples of fixed interest investments are corporate government bonds, income securities, and capital notes. And I had to look up what a capital note was. Capital note is a short-term bond issued by a company to help pay company liabilities. So rather than it being from the government, it's more of like a private sector away from the government. So really quickly, the last 5-step suggested plan for first-time investors, so for y'all. So we're going to break down these also individually. So the step 1 would be to access your current financial situation. So what you would do is you would evaluate where you are financially and decide what you can and can't do. But you need to, before you can decide what you can and can't do, you need to be able to look at yourself and be able to break everything down, budget, and see where your money's going, where it's going, and where it's coming from, and be able to understand where everything is. So then, when you do that, then you can create your budget and start pulling money off to the side that you can be able to use for investing. Step 2 would be to define your goals. So what is it that you want to get out of your investment? Do you want a long-term or short-term growth? The goal should be over the 3 things: safety, income, and growth. And then always ask yourself, why are you investing? You don't want to invest if you have no reason to. Obviously, the real reason would be to gain money, but if you aren't going to be focused on it, then you're probably not going to be as successful. So the third step would be determine your risk tolerance. So this is what I was saying before about risk versus reward. The more risk that you're willing to put in, the more return that you're usually able to get out. Stocks that are less risky, like I mentioned before, Tesla, Apple, they're going to have little ups and downs, but generally they're on an upwards trend just because of how popular they are. So those are low risk stocks, and by the end of it, you're probably going to have a lower return because you have to pay so much for it. But examples like I was talking about Novavax. Novavax was a COVID-19. They ended up getting beat out by that Russian company that got their vaccine. So my stock went down. It went right back to the price. It was about 200% greater than what it was, looking great. So I invested in it, made a high risk, and then because of the way the market works, I didn't get as much of a reward back. So that's something to make sure you pay attention to. Lower risk, again, is going to give you a lower reward, and then a higher risk will usually give you a higher reward. Now that's a general trend. It's not always a big thing. Yes. So then step 4 is to decide what to invest in. Again, this is a defensive kind of investment strategy, a conservative investment strategy. It breaks it apart into each of the different, you're diversifying your portfolio. You're not leaving all your eggs in one basket. From what we previously talked about, decide what your financial goals from step 2. Ask yourself what approach you want to the problem through your goals. You could decide securities like stocks, bonds, mutual funds, retirement plans, etc. You can go into any of those and decide, if you're young right now and you want to even start saving for your kids' college, you can start investing in things and moving forward for that. And then the biggest thing that I would say is make sure you diversify your portfolio. Don't throw all your eggs in one basket. If the stock market crashes and all your stocks and investments were in that, then that's going to be kind of tough. So just make sure you're paying attention to that. The last step would be to monitor your investments. Obviously, you can't just put your investments in and then forget about it. You're going to have to watch them and see what's going on, and even have to make adjustments as you go through. So what we talked about what investing is. We talked about the different types of investments. We broke down those investments, and then we went through the 5 successful steps for first-time investors. Here are my sources, and that is it. Thanks, guys.